So today I'm going to do a comparison between the top 10 S&P 500 stocks and see how well it's compared versus the S&P 500 in its entirety. And I'm going to go back several years and compare. And I'm going to compare to see if maybe this is going to be a good strategy or not. Please press that like button and share. It really helps the channel. Also, if you haven't subscribed already, please feel free to do so. If you look at the S&P 500 over time, it's changed quite a bit. This website here shows the S&P 500 right now. So you've got Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Johnson & Johnson. But look at what it looked like back in 2000. General Electric was the number one. Intel, Cisco, Pfizer, Oracle, AT&T, Nortel. So quite a bit different. And if you go back even further to 1973, IBM was huge, 8.4%. And AT&T was number 2 at 5%. And then you even had Kodak, 3M, Xerox, Sears. So it changes quite a bit over time. As you can see in this chart, how it's changed from year to year. As the stocks go up and down in value, they start moving up the index. What I'm going to do is I have this portfolio visualizer tool. I've created the S&P 500. I found the top 10 holdings for the S&P 500 for about 6 or 7 different periods over the last 20 years. And I'm going to upload that file for the portfolio. And then I'm going to run the comparison against the benchmark to see how well it's compared. So let's go to it. So the first one, let's add the current S&P 500 from 2023 and see how well it's done. Okay, so this one, if we actually go back to 1985, it's done tremendously well because you've got Microsoft and Apple in there. And if you look here at this line in blue, this is the 10 stocks. The red is the S&P 500. So this goes back as far as 2013. But you can see that the value of the portfolio in the end is $235,000 versus $35,000 for the S&P 500. However, there is a problem with this. Now, what's the problem with this? So I took the 2023 S&P 500 and I'm going back to 1985. We have the benefit of hindsight, and so that's the flaw with this, is that we have the benefit of hindsight. And of course, these are the stocks that have done we already know which stocks have risen in value, and we've selected those, and then we're going back in time. So that's really sort of cheating. So I'm not going to use this method. I'm just showing you, how you can kind of cheat, and this is not going to be accurate. I'm going to do this over again. Okay, so this time I'm going to upload the earliest one, which was I'm going to do the one from 2007 and upload it. These are the S&P 500 stocks, the top 10 from 2007. However, I'm going to only go back to 2007. I'm not going to go back before that so that there's no benefit of hindsight. I'm not going to rebalance, and I'm going to compare it to the S&P 500. So let's see how well this one's done. We're going to select 2007 as the starting point. Analyze. Okay. Now you see that this one has actually had the max drawdown on this portfolio is actually better than the S&P 500, and its worst year was better than the S&P 500 at -27 versus -37 for the S&P 500. When we look at this chart, you'll see that this 10 stock portfolio is up from almost the entire point until just recently during the tech stock sell-off in like 2021. So most of this time, and it's still better now. So it's actually generated this $10,000 portfolio is worth $46,000 versus $40,000 for the S&P 500. And when we look at the worst years, the S&P 500 has actually done worse. You can see there's down almost 40% one year. And even in 2022, down 18 versus up 5 for this one. So this one did pretty well. Let's look at the next one now. All right, we're going to look at 2010. Now these are just random ones that I pulled out. I didn't want to waste your time and do every single year. I just did every 3 or 4 years. So this one, we're going to select 2010 as the starting point. We're going to select not to rebalance, and we're going to do the S&P 500. We're also reinvesting dividends. Okay, analyze. Okay, this one, the same deal. So the best year, 44%. It's doing better than the S&P 500. The worst year, only minus 17 versus minus 18 for the S&P 500. The final value was almost 70,000 with this one versus 47,000 for the S&P 500. Now this one, the S&P 500, from about 2014 to 2019 did better, but you see that from 2020 on, it really took off. So, my first guess would have been this is going to be a 10 stock portfolio. It's going to have 50% decline. It's going to be up. It's going to return worse performance, and the price is going to be all over the place. But that's not the case so far. The next one is 2013. No rebalancing. We're doing 2013. So the top holdings from 2013, and you're just holding it every single year until the present. I did equal asset allocation just for simplicity. I didn't, put Apple at, 12 or 13%, and then, I'm just keeping it simple. So this one also did better. The final value, 47,000 versus 35,000 for the S&P 500. Now this one had the worst year was slightly worse at minus 18.49 versus minus 18.2 for the S&P 500. But we look at this one, you see the blue on top most of the time. And just like the other one from 2020, it really took off. And the worst year, they're almost even, which is surprising that you've only got, we're only got 10 stocks, and the performance is, the downside's not much worse than the S&P 500. So the 10-year annualized 15% for the 10 stocks versus 12 for the S&P 500. The total annualized is 16.3 versus 12.9 for the S&P 500. Okay, we're doing 2015 now. This one also did better as far as performance, although this one had more of a drawdown. It had a worse year. $36,000 final value versus $23,000 for the S&P 500. And here you can see the chart. So most of the time, it's all blue on this one. The max drawdown in 2022, though, was minus 32 for the 10 stock portfolio versus minus 18 for the S&P 500. Okay, now the last one is 2018. This one has Visa in there. This one also did better. A final value of 21,000 versus 17,000 for the S&P 500. The worst year was a little bit worse on this one at minus 22 versus minus 18 for the S&P 500. And most of the time you can see that the 10 stock portfolio did better. And just like the other one, this one had a slightly worse year in 2022 at minus 22. Okay, so is this a strategy? I was very skeptical at first. I didn't think this would work quite as well as some of the other strategies. I looked at some equal weight S&P 500 funds, and they didn't perform nearly as well as this 10 stock. Just selecting the 10 stocks from the S&P 500 and investing in those equally versus the completely equal weight S&P 500 that rebalances. So is this a strategy? I'm actually tempted to try this in the future. Now, a lot of you may be thinking, well, this isn't, it's not very diversified, right? You've only got 10 stocks. These 10 stocks equal 25%, roughly 25% of the value of the entire U.S. stock market. I'm not talking about the S&P 500. I'm talking about the total stock market. So, 4,000 something stocks. So these 10 stocks equal the market cap of roughly 25% of all stocks. So you're capturing roughly 25% of the stock market with just these 10 stocks. I mean, that's pretty incredible, to me. So just this S&P 500, if you do all 500 stocks, is 80% of the US, roughly 80 to 85% of the value of the US stock market. 28% of the US stock market is in these 10 stocks. So this equals 28% of the S&P 500 is in these 10 stocks. These stocks equal 25% of the entire stock market cap. So although you're only holding 10 stocks, they're worth so much, and these companies are such a major part of the economy that it's actually fairly well diversified with only 10 stocks. And we know that, the famous investor Warren Buffett is widely known for holding only, 20 stocks. So it's not the craziest thing in the world to have a small number of stocks like this. So I'm tempted to try this in the future, and I do have something that I think will help you if you want to do something like this. So M1 Finance has an option where you can select. M1 Finance is a broker, and they'll allow you to select. You could do a market order right now, do 10% in each of these stocks, and it'll place the order the next day, or it'll place the order for all these with 10% of your assets in each. Now I have a referral code that I'll put a referral code in the description where you can sign up with M1. You can sign up with as little as $100, and you can get up to 5% on a savings account. They also have a savings account if you sign up with their M1 Plus, which is pretty high for our savings. Or if you invest at least $5,000, you can get $100 back. You'll get a $100 bonus. You'll get a $100 bonus if you invest at least $5,000, and you'll be able to do pie investing where you invest a percentage. Now they've got joint accounts, Roth IRAs, custodial accounts. So check out the link in the description. I hope you liked this video. If you have, please press that like button. It really helps. And feel free to subscribe or comment below. Have a good one.